Hi guys, this is Terry with Futures IO. First, I want to take a moment to direct your attention to this support link. If you're interested in donating to the Red Cross in support of the earthquake recovery in Ecuador, then please feel free to visit this link and donate there. Big Mike has asked people to focus on helping those who were greatly affected by this tragedy. Now, it is my honor to welcome back Al Brooks for today's webinar.
Thanks, Terry. Hi, everyone. This is Al Brooks, and I want to thank Terry, Big Mike, and Futures IO for giving me the opportunity to speak. You know, I've never met Big Mike, but I've had many exchanges with him over the years. And yeah, I got to say, I'm really impressed by the guy. He's a really honest guy and a very caring guy, and he's trying to do a very good job to help people. So, you know, I think we're all fortunate that he is running the site. Now, I also want to give a disclaimer in advance. I had significant surgery 2 weeks ago, and I am not at my best. So, you know, please bear with me. Also, because of the surgery, I did not have as much time to prepare the presentation today as I normally would like to have, but I think it's still going to be pretty good. I took the slides from the new version of my course that I've just about completed. I've completed the slides, and I will do the editing, and then I will start the audio over the next several months, so hopefully it will be all ready to go within a few months. Anyway, today what I'm going to be talking about is, I think, a really important issue. Every day you see the market going up, and you see the market going down, and then you see the market going sideways. And I spend a lot of time every day paying attention to transitions. And today I'm going to be talking about, let me just check this presentation. Okay. Let me just check the GoToWebinar thing. All right. Yeah, well, anyway, every day I spend a lot of time paying attention to market conditions, and it helps me determine how I want to trade. Today I'm going to be talking in particular about transitions from trends into trading ranges, and there are a lot of opportunities to trade there. I don't know if you were trading the E-mini this morning, but during the first 2 hours the market was going down pretty relentlessly, and I just kept saying in my chat room, look, the bulls are making money buying every new low, buying below the low of the prior bar, buying the prior low of the day. And when you see that, the odds are really, really high that the sell-off is going to be a leg in a trading range. And as you know, that's exactly what happened. We reversed up, and then ultimately we reversed down and closed somewhere in the middle of the day. But if you have a bear trend, and it's really easy for the bulls to make a lot of money with limit orders using wide stops and scaling in, chances are that bear trend is not going to last very long. These are the things that I'll be talking about today. I'm going to be talking about limit order bulls and bears. In other words, when bulls enter with limit orders, I call them limit order bulls. When bears enter with limit orders, so if the market's going up and the bears are selling above things, those are limit order bears. I'm also going to be talking about gaps, and I use the term gap probably in a very broad way, differently from most people. And then what I just talked about a moment ago, legs in trends versus legs in trading ranges. And then there's a particular thing that comes up a lot when you have a lot of trading range price action. You know, the market has a leg up, has a pullback, and then it has a very strong second leg, and everyone assumes that that second leg is going to be a breakout that leads to a big bull trend or a big bear trend, and instead it just reverses. And I call those second leg traps. And finally, I'm going to be talking a little bit about scaling in. So entering with stop orders, you know, this is pretty clear, right? You know, if you're a stop order bull, if you're a bull looking to enter with a stop, here we have a pullback and a bull trend. You place an order to buy one tick above the high of that bar. This bar is the signal bar, this bar is the entry bar, and your entry price is one tick above there. So as soon as the market goes one tick above the signal bar, it hits your stop order, and your stop order becomes a market order. And in the E-mini, there's usually very little problem with slippage. So in a big volume market like the E-mini, usually if you place an order to buy one tick above a buy signal bar, you'll get filled exactly at that price. You know, maybe 5% of the time you'll get slippage. And if you're buying a pullback in a bull trend, you put your stop one tick below the low of the buy signal bar. In general, this is the first trade that traders should be taking when they're starting out as traders. They should be looking for stop entries, not necessarily a stop entry pullback. They could buy a stop entry reversal or sell a stop entry reversal, but in general, beginners should use entries because at least the market is going their way. They're getting swept into the move. Now, there are also buy the close bulls. You know, if the market is breaking out strongly and there are no pullbacks yet and you're not yet long, you know, you buy the close. As soon as the market closes, you place a market, you just hit buy the close. You just buy the market. Or you might, if you're fast, you might be able to place a limit order. As soon as this bar closes, you place a limit order to buy that price. So this is the breakout bar, broke out above these two bars. Here's the follow-through bar, and those are buy the close bulls there. And then if you have a really strong breakout and you just are not long yet and you're pretty confident that the breakout's big enough so that it's going to go at least a little bit higher, you can simply buy at the market, which I do a lot. I enter at the market a lot. And if you do have time and you're comfortable entering with limit orders, here you have a pretty good leg up, probably buyers below the low of this bar. So I would not sell with a stop below that bar. Instead, I would buy with a limit order at the low of that bar. The same true here. The move up is so strong that this reversal down probably will fail. There probably will be more buyers than sellers here. So I will not sell on a stop one tick below that bar. Instead, I'll place a limit order at the low of that bar, and I'll buy with a limit order and use a wide stop possibly all the way down here. So that would be a limit order bull. Here's a buy the close bull. And then the bull who buys above this bar is a stop order bull. So when the bears start to think that, maybe we have a buy climax, we've got 4 consecutive bear bars, another couple of bear bars here, maybe we're entering a trading range. When the bears start to think that a trading range is likely, or at least you'll get a pullback that will fall far enough to make money, you start getting limit order bears. They'll place an order to sell at the high of that bar, or to sell at the high of this bar, or sell at the high of this bar. Right, with limit orders, or as soon as this bar closes, they'll place a limit order to sell the close of that bar. And when the limit order bears can start to make money, right, you have to assume that the market is transitioning into a trading range. Here we have a bunch of bars down, but we're still a higher low. The picture looks confusing, maybe a double bottom. For the bears, it's a bear breakout below a bull channel, right, but as a bull bar, bull body here, that's probably a low probability sell. The market's probably transitioning from a bull trend into a trading range. Markets typically do not go from a bull trend into a bear trend. So this is probably a trading range. This is a reasonable low, double bottom. And here we have a sell signal bar with a bull body at the bottom of a trading range. The bulls see that and they think it's a bad sell. So they think there are more buyers than sellers below that low. So the limit order bulls, as soon as that bar closes, they place a limit order to buy that low or this low, expecting there to be more buyers than sellers here. Limit order bears, they see 5 bars down and a weak bottom. They'll sell that high. So the limit order bears will sell this high, scale in higher, stop up here, look for a scalp. And again, limit order bulls buying a new low. Here they buy a bear flag, and we have a bear trend, a pullback, so it's a bear flag. They're buying the low of a bear flag, betting the bear breakout will fail. Here they're buying, the limit order bulls are buying a breakout to a new low, betting it'll fail, just like the limit order bears sold this breakout. Even though it's a pretty good looking breakout, they sold it betting that there was enough selling pressure for the market to begin to transition into a trading range. Every tail is a failed breakout. It's a failed bear breakout, failed bull breakout. And if you have a lot of tails, probably it's better to bet that breakouts will fail. If every tail is a breakout, a failed breakout, and you're getting a lot of tails, it's better to bet that breakouts will be failing. So if you have, if most bars have a lot of tails, and if there's a lot of overlap between the bars, and you're rallying but you're getting a lot of bear bars, this kind of environment is bad for stop entry traders. So traders buying the breakout above this bar, bad. Buying above this bar, bad. Selling below these bars, bad. Right? This is more of a limit order market. It's better to be buying below bars, selling above bars, and that's usually a sign that a trading range will be starting soon. So tails above bars means sellers above. And when you start seeing that, bears start selling at the high instead of bulls buying there. And a new high here, bears sell it. A bull flag, but 3 bars down, 2 dojis, right? Bulls will lose and bears will win. So the stop order bulls will not make money. The limit order bears, the opposite trade, will make money. Tails below bars means buyers below. So instead of a successful breakout, bulls are buying, bulls are buying, bulls are buying. And when bulls start to see that, limit order bulls start to place orders to buy prior lows. So they place a limit order to buy that low. And they place a limit order to buy that low, that low. Here we got a bear flag at the bottom of a developing trading range. The bulls will bet the bears will lose, so they'll buy below bars. They'll buy below there, they'll buy below here. So these are limit order bulls down here and limit order bears up here. And they win when you start to transition into a trading range. And if you see that a lot of limit order traders are making money, if there are a whole bunch of limit order setups that are profitable scalps, you have to assume the market's transitioning into a trading range. Now, I want to talk briefly about gaps. To me, a gap is any space between 2 prices, a support price, a resistance price. So, for example, here we're breaking out above this high, and there's a gap between that low and the breakout point, and there's a gap between this pullback and the breakout point, so that's a gap. This close and that high, this close and that high, that's a gap, okay? This close and this high is a gap. And I pay attention to whether or not these gaps stay open. So this close, this high is a gap. We tried to close it here, but we could not. So the limit order bears selling up here, we scaled in, they sell this high, sell more higher. They were not able to get out at the original entry price. Probably the market's going higher. Here, a gap, this close and this high, and this low, this high and that low. We have a gap here. It closed on the next bar, so I refer to that as an exhaustion gap. So if you have a gap and it immediately closes, that's an exhaustion gap. Gap here, this closed, that high, it closed immediately, an exhaustion gap. More common when a trend is starting to end. Another gap, strong rally, a pullback testing the high of the buy signal bar, and that is a breakout test. It's another gap there. It's a sign of strong bulls. The bears could not close the gap. Measuring gaps, okay, we have a gap between this low and that high, so you got to be thinking that the market might fall for a measured move. Okay, sometimes the measured move is from the middle of the gap, so from the top of the move to the middle of the gap. Sometimes it's from the top of the gap, and in this case, the measuring gap, the measured move was from the bottom of this trading range, from this low down to a measured move based upon the top of the range. Markets, I'm always looking for gaps. So I see a big bear bar, I look at the first pullback, and I look at the breakout point. If there's a space, I start thinking that will fall for about a measured move. Here we got a bull channel, and we have a bull breakout, and the biggest bull bar in the past 20 bars, maybe past 30 bars. So is this going to accelerate up and become an even stronger bull trend? Well, whenever you get the strongest looking bull bar, especially a series of bars, occurring 20 or more bars into a trend, you have to be thinking that exhaustion is more likely than acceleration. A gap, this close and that high, a gap, that close in the trend line. So it might be a measuring gap, but 75% chance it's an exhaustion gap, and the gap will close. So all the gaps close, this high, the trend line, that, this close, and the breakout point, and we reverse down. So whenever you see unusual strength late in a trend, especially a bull breakout above a bull channel, chances are it's going to fail. And we have gaps. The bottom of the climax bar. We've got, well, this is not drawn in. I got to redraw this, but this line is supposed to be on that high. This line is supposed to be on that low. And we got a couple gaps. In any case, the gap's closed, and I call them exhaustion gaps. Now, every bull trend is made up of one or more of these four components. Okay, sometimes the component may only be 1 or 2 bars long. Sometimes it can be 20 or 30 bars long. In some charts, sometimes the chart will be all of one pattern, just a bull breakout that keeps going up and down, a broad bull channel that goes up forever. Here we have a bull breakout, lots of gaps. This closed, that high, this closed, that high, this closed, that high. Right, not much overlap, no pullbacks, no bar falls below the low of the prior bar. Okay, and bears cannot make money. Right, so you cannot be selling. When you see that, you're either doing nothing or you're buying. Alternatively, less strong but still very bullish, you can have a very tight bull channel where you have brief pullbacks, 1 bar, 2 bars, and they fall very low, but again, it's still very difficult for bears to make money. We have gaps and almost gaps. This is almost a gap. I call it a negative gap, slight overlap of the pullback and the breakout point, here, here. Very hard for the bears to make money in a market like that. So when you see that, it's better to only buy. A broad bull channel, okay? You get pullbacks that last 5 or 10 bars, you get a lot of bear bars, and the gaps close, okay? And the bears can make money in this bull trend, okay? So if they see all this two-sided trading, they'll sell at that high. They might sell more higher, and see they can scale in higher. And then they take profit on a pullback here at the bottom of the most recent buy climax bar. So here you have a bull trend, but the bears are making money. And then a trading range. Bull trends often have trading ranges. The bulls and bears are about equally strong, and it's easy for both the bulls and for the bears to make money in a trading range. The bears, they'll bet breakouts will fail. They'll sell at prior highs. They'll sell reversals down below strong bear bars. And the bulls, they'll bet reversals up, especially second entries, 1, 2, will be successful. They'll buy above bull bars near the bottom of the range. Here we get a micro double bottom, down, up, down. They'll buy a micro double bottom at the bottom of the range. And in a bear chart, every bear trend that you look, it's made of one of the 4 patterns: strong bear breakout, tight bear channel, broad bear channel, or trading range. And it's similar to what I just said about the bulls. In a bear breakout, there are no pullbacks, or the pullbacks might be just tiny, and it's very difficult for bulls to make money. And then when you're in a tight bear channel, some pullbacks, 1 or 2 bars, but you tend to get gaps. The pullback here, there's a gap with that low. And when you start getting gaps or almost gaps, it's pretty difficult for the bulls to make money. Usually better only to sell. And then here, when you start getting broader channels, and you get pullbacks lasting 3 bars, 5 bars, 10 bars, and you get a lot of overlap, right? It starts to become pretty easy for the bulls to make money. So, the bulls can buy that low, they can buy more lower, and when it gets back to the first entry, they get out break even on their first entry and a profit on their second entry. So when you're in a bear trend and it's starting to become easy for the bulls to make money, you're probably starting to transition into a trading range. And then this slide on the right, I talked about this a moment ago, that both bulls and bears can make money. Now, whenever you see a trend like this, I'm always looking at it and I'm wondering, is it really a trend or is it a leg in what will become a trading range? To me, this is a small pullback bull trend. It's a fairly tight bull trend. Pullbacks are small. Maybe a lot of bars, but they're not falling very far, all right? Not falling very far. And it looks weak. You see a lot of dojis, a lot of bear bars. You see a lot of overlap, and you say, that's not a very good trend. It should turn into a trading range pretty soon. Well, yes and no. There are 2 problems with it, okay? So you get a trend where everything looks kind of weak, but you're starting to get gaps, all right? That's a problem, all right? So if you have a trend that looks weak, but there are a lot of gaps, and the pullbacks are not very deep, right, it's usually better only to look to buy. This is a small pullback bull trend, and if you look at a higher time frame chart, it's usually a breakout. And if it's a breakout on the 15-minute chart, that's a pretty strong trend. It's usually better only to buy. And this is what a 15-minute breakout looks like on a 5-minute chart, a small pullback bull trend. This is not something that is about to transition into a trading range. So if you see gaps and very small pullbacks, only look to buy, do not sell. A lot of these gaps lead to measured moves. You get some profit taking near the measured moves. And all of these gaps trap limit order bears. So a bear who sells this high, sells more higher, does not come back to his original entry price. He gets trapped and he has to buy back his shorts with a loss. So whenever you see gaps in a tight channel, you should only be looking to buy. Here's a bear version of the same thing. So a small pullback bear trend, you have a lot of overlapping bars, okay? Many small bars instead of big consecutive bear bars closing on their lows. A lot of bull bodies, you got bull reversal bars, right? But so it makes you think it's going to turn into a trading range soon. But when the pullbacks are small and you're starting to form gaps, very little overlap or no overlap, it's better only to look to sell. The limit order bulls buying below bars are going to get trapped, and they're going to have to sell out with a loss, and that usually means the market's going lower. Here we have a gap, and so you've got to be thinking possible measured move. Here's the measured move, and at that point bears start to take profits, bulls get a little bit more aggressive, and at that point you can get a reversal up. Gaps, again, usually mean that if you look at a higher time frame chart, 15-minute, 30-minute, 60-minute chart, even though it looks like a possible leg in a trading range here, it's actually a very strong bear trend, and you should not look to sell. So let's say a bear sells here. They sell more here, sell more here, sell more here. Really hard to make money. He sells here, he sells here, he sells here, sells here, 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 right? If it's really hard for the bears to make money, if the limit order bears, limit order scale in bears, selling with limit orders scaling in higher, if it's hard for them to make money, once you see this kind of stuff where it's just really hard to make money as a bear, don't sell, only look to buy. The trend is much stronger than what it might appear. So whenever it's hard to make money doing something, it's usually better only to do the opposite. So if the limit order bears are losing money, don't sell, only look to buy. So if you're buying, you have to first determine where your stop goes, and you determine your position size based upon how far your stop is. If your stop is far, you trade smaller. And I'm just going to go through this slide quickly, and you'll be able to pause it on the video. Here's the same thing right here. You know it's a bull trend. You know it's going up. Nothing's 100% certain, but you know it's going up, so you have to buy. You can buy the close of a bull bar, the close of the follow-through bar. You can even buy the close of a bear bar, betting the bear reversal will fail. And if you can't decide what to do, just buy at the market. But the important thing is you have to buy. A lot of beginners are often afraid to buy as the market is falling, but buying pullbacks is a good strategy. You're betting that the bear reversals will fail. So you buy the low of the prior bar, you buy 1 or 2 points below the low of the prior bar. You don't do all of these, you pick one, all right? You buy a bear close. Buy pull back to the breakout point. I'm just going through this quickly because this is really not the purpose of what I'm talking about today. I want to be talking about transitions, but I just want to give examples of ways to trade. Okay, so when you see this, you're wondering, is this a bull leg, and what will be a trading range? Will we fail, or is it a bull leg and a bull trend? Here we have 8 consecutive bars up with one small bear body, and several of the bull bars are closing on their highs. This is probably going to be strong enough to result in some kind of a measured move up. So at this point, it looks like a bull leg and a bull trend. And then up here, you're starting to get an absence of consecutive big bull bars closing on their highs. You're getting a lot of overlap, a lot of pullbacks every couple bars. Right, so this is probably going to be a bull leg in a trading range. So if you start to see a lot of pullbacks, deep pullbacks, so you get a breakout, the pullback comes back more than 50%, right? Those are signs that the bull leg is probably not going to last forever, and it's probably going to transition into a trading range soon. So here you have still a bull trend, but it was actually a bull leg in what became a 4-hour trading range. Okay, is this a bear trend, or is this a bear leg in what will become a trading range? We have a pretty good reversal down, so a spike down. but bad follow-through. We're getting bear bars, but big tails. Where are the consecutive big bear bars? We're getting big tails, dojis, big bear bar, but a reversal, right? That is not how strong bear trends typically look. So this is probably a bear leg in a trading range. Bulls buying that low, scaling in lower, buying that low, buying lows, they're making money. You buy this low, you buy more lower, you can get, it comes back to your original entry price. It gets at least one tick above the original entry price. That means that the bulls who bought here get off break even, and those bulls, if they scaled in lower, they made money on their lower entries. So the limit order bulls are making money on every new low. That is much more common if a sell-off is going to be a bear leg in what will become a trading range. Also yesterday we had a lot of trading range price action, and then the trading range price action today increases the chances that this is just a swing down in what would be a trading range. We have a measured move down. We have a lower high. It could have been a measured move down here. We have a double top, double bottom measure, so it's possible we can fall for a measured move. I always look at the nearest measured move first. A gap or almost a gap here fell to almost a measured move. We got a spike down, 3 pushes, 1, 2, 3. A very common pattern: spike and channel, bear trend, wedge bottom. This is probably going to go sideways or up. Okay, stop order bulls. Here it went up far enough for the stop order bulls to make money. So this is really a problem for the bears. So this is probably not going to last as a bear trend. The limit order bulls are making money. Now even the stop order bulls buying above bars are making money. So probably not going to be a bear trend. It's probably going to be a bear trend in a trading range. Here's the opposite. Here's a bull trend. Strong breakout above above highs. Okay, but where are the consecutive big bull bars? Big bull bar, bear bar. 3 bull bars, but not very big. 3 bull bars, but tails, dojis. All right. This is not how strong bull trends typically look. We're getting reversals every few bars. A bull leg in a trading range is more likely than a bull leg in a bull trend. So when you start to see things like that, you got to be prepared for a reversal, or at least the market going sideways, and you cannot be buying at the high of anything. Limit order bears, they sell that high, they sell more higher. It comes back below the breakout point, so they can get out break even on the first entry, profit on the second entry. Same here. You sell more. It comes back below the breakout point, so you make money on your second entry, break even on your first. Limit order bears are making money. Usually they cannot do that very much in a bull trend. If they are successful at it, it's probably a bull leg in a trading range. A lot of two-sided trading, limit order bulls making money. Stop order bulls, if the stop order bulls can start to make money, it may be more than just a trading range. It may be a bull trend or a bull swing. Okay, once traders believe that the downside is limited, in other words, that it's not really going to be a trend, traders start to trade it like a trading range. Even though we're still in a broad channel, high, lower high, lower high, lower high, lower high, so it's still a bear trend, lows, lower low, lower low, but broad channels, limit order bears, easy to make money. Broad bear channel like this, you trade it like a trading range. You buy low, you sell high, you scalp, you use wide stops, you scale in. Bulls buy bear breakouts. Bears take profits at new lows instead of selling more. And okay, I know this chart is condensed. Let me get a drink of water here. Let me cancel that out. I know this chart is showing a lot of bars, but it does illustrate what I want to talk about. Okay, if a market's in a trading range, a lot of times, most of the time, legs tend to subdivide into 2 legs. So 1 leg up, 2 legs up, and a reversal. 1 leg up, 2 legs up, and a reversal. 1 leg down, 2 legs down, 1 down, 2 down, 1 up, 2 up, 1 up, 2 up, 1 down, 2 down. Many legs also actually subdivide into threes, into wedges. So you get 1, 2, 3, 1, 2, 3, 1, 2, 3. When you see a lot of price action like that, it's trading range price action. You know, it's good to be looking to buy reversals up from wedge bottoms or 2 legs down. And it's good to be looking to sell reversals down from wedge tops and 2 legs up. You know, that's how you trade trading range price action. Now, a second leg trap, I mentioned this earlier. A lot of times you'll get a very strong second leg and you'll assume it's the start of a bull trend. But 80% of breakout attempts in trading ranges fail. So, you know, when you see a strong bull breakout or a strong bear breakout, you have to assume the breakout is a trap and it's going to fail. You know, beginners see this and they think, oh wow, bull trend. Oh wow, bull trend. No, bear trend. No, bear trend. But these are just second leg traps. You know, they assume the trend is taking over and the trading range is ending, but 80% of the time they're just traps that lead to reversals. So 1 leg up, 2 legs up. Here, 1 leg up, 2 legs up. The bulls see this and they think, oh wow, this is a reversal. No, it's 2 legs up in a trading range day. It's more likely a trap, and it's more likely to reverse down. So the beginner buys the close of strong bull bars, thinking that we're going to go up, and they buy the close of that bull bar, thinking, oh wow, this is the start of a huge bull trend. And it might be, but it's probably not. Beginner, oh, we're breaking out to a new high. After a strong leg up, I got to buy. No, exact opposite of what to do. We have a double bottom. We're breaking out above the neckline of the double bottom. Okay, so same thing with legs down, right? Here we got 2 legs down over here. Beginner thinks, big bear breakout bar, follow through. You know, we're going to break below this and fall for some kind of a measured move down. It's the exact opposite of what to do. And, you know, the beginner, he buys this close or he buys up here and it starts to reverse and he just, you know, gets panicked and paralyzed by the fear. He thought he took a good trade, but now he sees the prospect of a big loss. Okay? You know, beginners a lot of times they'll buy this and they'll hold saying, oh, it's got to be a second leg up. Oh, this is so strong, we got to get a second leg up. You cannot do that. You know, as soon as you realize that you're trapped, take the loss, just get out. So we got a bear reversal bar, possible 2-leg trap. Here we got consecutive bear bars. You just get out and take the loss. Down here, 2 legs down, you got a bear bar and another bear bar, but it's also possibly an expanding triangle. 1, 2, or 2. Well, anyway, higher high, and then 3 legs down. You know, that's more likely a reversal pattern than the start of a bear breakout. So when it starts to reverse up, especially micro double bottom, down, up, down, you got to get out. Just take the loss. You should not take the trade in the first place. But if you do take the trade, you cannot be in denial. So a strong bull breakout, new high, you know, 3, 4 consecutive bear bars, you just get out. Just sell at the market. Just get out, because chances are it's going to fall a lot further and you're going to lose a lot more. And then if you're pretty good at reading charts, you see 3 pushes up, 1, 2, 3, and an expanding triangle, 1, 2, 3, and other reasons why this is probably a top instead of a bull flag that will lead to more up. You know, experts, they see these second legs in trading ranges and they do the opposite. So when an expert sees that big bull close, they'll say, yeah, the beginners are going to buy it, the dummies are going to buy it, I'm going to sell it, betting on the reversal. Or they might sell below the bear bar after it reverses down. Or they might wait for a couple of consecutive bear bars and then sell. These are all good things to do. They may also sell the high of this bar, betting that the bull flag will fail and that will fall more. Okay, same thing over here. So a lot of trading range price action. Instead of buying up there, you place a limit order to sell at that high, or you'll sell below the bear bar on the reversal down. Micro double top, 1, 2, double top, 1, 2. Or you could wait for 3 or 4 consecutive bear bars and then sell. So second leg trap more likely than a bull breakout. Or you could even wait to this point. The reversal down is so strong at this point, 6 or 7 bars down. So you sell that close, you sell that close, stop up here, and expect at least a little bit more down. And opposite at the bottom. Instead of selling at the new low, an expert will buy that low, betting that we have so much trading range price action, it's more likely to reverse than lead to a measured move down. You can buy the reversal up. You can wait for a micro double bottom. So down, up, down, up. You can buy the close of the strong bull bar. You're still buying in the bottom half, bottom third of a trading range. So the math is good for the bulls. A lot of times you'll see a breakout and you say, gosh, this could be a bull trend. We need one more bar, another big bar, breaking out above a big tail. One more bar and we got it, right? Well, smart bears know that the bulls think that way, and what they do is they sell the close of these strong bull bars, betting against that one more bar up, right? So they see these strong bull bars and they sell the close. They know the bulls need one more bar. The bears bet the bulls are not going to get one more strong bull bar, so they sell that strong bull bar. And at the bottom, the opposite. The bears think, we're breaking out, just need one more big bear bar like that, and then we'll make a lot of money. The bulls know that, and they bet that, bottom of a trading range, you're not going to get that other bar. I'm going to sell, I'm going to buy that close. I'm going to buy this close. I'm going to buy this close. I'll buy this close. I'll buy this close. At least for a scalp, betting that the bears will not get their breakout and their follow through. Excuse me. Trading ranges are very forgiving for traders who use wide stops and scale in. If you do that, it's usually even if you sell the worst price of the day, all right. If you're a limit order bear and you know how to scale in and use wide stops, usually you can at least avoid a loss. Okay, so you sell this low, the worst price of the day to sell. But if you're an experienced trader, you look to sell more, 50% pullback, maybe a reversal down. And now at this point, you're not trying to make a profit, you're just trying to avoid a loss. So your average price, you sell here, you sell more there, your average price is here, and you get out, break even at the midpoint of the two entries. Market's rallying strongly. Let's say you buy the new high. Let's say you buy the very high of this bar. If you don't panic and you manage correctly, you buy more, 50% pullback. So here's the leg up, 50% pullback. Or you can buy the reversal up above a bull bar here, and just use your stop down here. And you can get out break even on your first entry, small profit on your second entry. So limit order traders, trading ranges are really forgiving if you know how to scale in, manage your trade, use the correct stop. It's usually pretty easy to avoid a loss. Another possible second leg trap here. We have a lot of trading range price action. We get a bull breakout above a wedge, 1, 2, 3. Very strong breakout, follow through. What's more likely, a successful breakout and a measured move up, or a failed breakout and a reversal down? At this point, it's more likely the first reversal down will be bought. But let's see what happens. So we got a breakout above the top of a possible trading range, top of a possible bull channel. Good follow through, breakout and follow through. Okay. First reversal down will probably be bought, and there'll be at least one more leg up. That leg up may only be a single bar. It's also a strong breakout above the top of a bull channel, so it's the breakout above a higher high and a breakout above a bull channel. A bull breakout of a bull channel, 75% chance it's going to reverse down in 5 bars. So gap, this close, that high, gap, this close, the trend line, another gap, this close, this high, this close, that high. All right, so it's gapping up to a new high, but it's a possible exhaustion gap, an exhaustive buy climax. It could be the start of a measuring gap, it could be the start of a measured move up, but a bull breakout above a bull channel, 75% chance it'll fail. A bull breakout above a wedge top, 50-50 chance it'll fail. And then you see this, okay? The bulls buy the first reversal down, right? So they buy at that low, expecting at least a little bit more up, and they got there a little bit more up. But look what happened. It immediately sold off, right? So this is a problem. You know, it looks like it's not going to go strongly up. I would not sell below this low, but here we have a second entry short, both bars closing on their lows. I would definitely get out of longs, and I would consider selling short here, or I'd wait for this bar, that bar, this bar, or even selling this high. So second entry, so here's the first entry short, not high probability, probably buyers below. Second entry short, now the probability favors the bears, so you get out of long, so you sell there. Big up, big down, big confusion, big disappointment, hallmarks of a trading range, confusion and disappointment. So you got to be ready for two-legged traps, right? Big up, big down, trading range likely. So you got to start thinking about, oh, we've got two legs down. One, pull back. Two, looks like we're trying to break out, but we're still a higher low. This could be a second leg trap. So a possible reversal up. So you don't want to be selling low. Trading range still, right? First leg up, pull back, second leg up. Looks like we're breaking out. Yes, we're breaking out above these bars, but not yet above this bar. Still a lot of trading range price action. So again, as bullish as it looks, you're still in a trading range. You want to buy low. You don't want to be buying high, because too often buying high, even a strong breakout like this, you're buying at the top. You're buying a second leg trap. So even though you're seeing strong bull bars, do not buy high. Even though you're seeing strong bear bars, do not buy low if you have a lot of trading range price action. The odds are you're going to get trapped. So the bears get trapped into selling low, and the bulls get trapped into buying high. Eventually, there'll be a successful breakout, but can you see a couple things different about this breakout from all the other breakouts that I just showed? Okay. Here we got a big bull bar, and we got a big bull follow-through bar, and they both, so we got consecutive very big bull bars closing on their highs, no significant tails, a little bit here, and the close is above the high of the past 20, 30, 40, 50 bars, way above the past 30, 40, 50 bars. So this is probably going to lead to a measured move up, at least based upon the height of the body. So this low, this open, and that close, you expect a measured move up at a minimum, 70% chance. Now I want to talk a little bit about this market cycle. Only 10% of the bars on any chart, just pop up any chart, 10% of the bars are in a strong breakout. 90% of the bars are usually in a channel or trading range. So here we got about 100 bars or so, and about 5 or 6 of the bars are in a strong bull breakout. And when you're in a strong bull breakout like that, you got to be thinking about a measured move. So breakout, follow through, bars are shrinking here. But at a minimum, I'm thinking we'll get a measured move based upon the height of the breakout. So you can buy the close of the bar, 70% confident that it's going to go up for a measured move before it gets down below the bottom of the breakout here or here. Double bottom, a low, another low. Close, we get a gap, the close of this bar and the neckline of the double bottom, neckline. You got to be taking partial profits around the measured move target. Very good trader's equation. Okay. Okay. Let's say you decided that it's a trading range. I'm going to sell this high. Okay. So let's say you sell that high. What do? Most bears will say, uh-oh, a second follow-through bar, another follow-through bar. Most bears would get out here or here and take the loss. But let's say instead you decide to hold short and just keep waiting for the market to go up at least the size of a scalp, maybe 2, 3, 4 times the scalp, and you wait for a bear bar. And you see that, you place a stop order to go short 1 tick below this low. So you sold here, okay, and you held short all the way up here, and you sell more here or here below a bear bar. Okay, after you see all this, you're saying, darn, I'm not going to make any money. I'll just try to get out between my two entry prices. So I sold here, I sold more here, right? Here's my average price, so I can get out here, or you can wait for the reversal up, double bottom, triple bottom. So, if you use wide stops and scale in, and you do not, get upset, even if you do something dumb, you usually can avoid losing money. Did not quite fall to your original entry price, so the bears they'll sell here, they'll sell more here or here, and they'll give it a chance to get down here. They'll get out break even at this price and with a profit up here. But they tried a third time. At some point, the bears just give up and they say, okay, it's not going to get back to my first entry price. I'll just get out around my average entry price and avoid a loss. Now, I said most bears would get out here. It's just really hard to hold short when you're getting all these great buying opportunities to make money. And usually, if I make a mistake like this and the market goes up, I get out here or here, and I just start looking to buy. But if you did hold, and you didn't lose your cool, you can still get out with an avoiding loss. You get a drink here. Okay. The most common reason why traders lose money is they make management mistakes. They have too big a position size. They scale in, not not reducing the position size enough. They use too much risk, too little risk. They try to get too big a reward, too little reward. And if you mess up at any step of the way, you can lose money. Now, I said 10% of the bars on any chart are in breakout mode. 90% are in a trading range or a channel. So we have a channel up, a channel down, but basically a trading range. When you're in a trading range, 40 to 60% chance the market's going to go up, continuing up or continuing down or reverse. So when you're in a trading range, at any point, the chance it's going up, the chance it's going down, it's going to be between 40 and 60%. So even if you buy at the low or sell at the low, 40 to 60% chance you make money, right? At any place in here, 40 to 60% the market's going to go higher, 40 to 60% the market's going to go lower. That's important to know. So 90% of the bars on any chart, the probability for buying and the probability for selling is within a band of 40 to 60%. And that's important. That's very helpful to know. Even if the probability is only 40% chance that you make money, you can still make money if you go for a reward that is at least 2 times your actual risk. So 90% of the time, you're not in a breakout. 90% of the time, both bulls and bears can make money if they manage their trade correctly. So 90% of the time, worst case, if you manage well, you can avoid a loss at a minimum. Even if you sold the absolute bottom of this trading range, right, you can still avoid a loss or make money if you manage well. So for example, you can sell here and then wait for a bear bar, sell more there, and then just patiently wait until it comes down to your original entry price. You sold the breakout of that low, right? And it got back here several times, did not get below there. So at some point you just get out on a reversal up. You'll make a little bit of money here, you'll lose a little bit of money here, and worst case is you get out around break even. Let's say you buy the absolute top. You put a stop below the bottom. You buy more above a bull bar. It got back to your original entry price, so you get out break even on your first buy and a small scalp on your second buy. So even buying at the top of the trading range, you can make money. Even selling at the bottom of the range, you make maybe a little money, or you get out break even. You avoid a loss. So it all comes down to management. Okay. Most skilled traders can use wide stops. They often scale in. If you're not confident about whether a reversal is going to be successful, wait for a second entry or for a strong reversal. So here, first reversal attempt, second reversal attempt here. A lot of traders will buy here, or they'll buy here, or they'll buy here and use a wide stop, confident that it's not going to fall far. It may fall more, but it's not going to fall far, and you're buying in the bottom half of a range. At the top, you never know where the exact top is, but if you use a wide stop and you don't panic out, you can always sell more below a bear bar and avoid a loss or make at least a little bit of profit. And if you don't want to take this short, wait for a second entry short. Here's the second entry short. Higher probability of success. We have a trading range here. Became a bigger trading range here, but a trading range here. In general, you want to buy low in the bottom half, sell high in the top half. If it's in the top half, I don't want to buy. If it's in the bottom half, I don't want to sell. So you sell reversal down in the top half. And now we got a bigger trading range. You buy a reversal up in the bottom half. You want to buy low, sell high. If the second leg down is really strong, wait for a second signal, right? So a pretty strong bear reversal, first signal, or first signal here, second signal over here. Higher probability to make money, second signal. Now we got a micro double bottom, down, up, and then down. So that's a second signal buy, higher probability buy. You can buy the follow through. When a leg up is strong, wait for a second entry sell. Micro double top. We went up and down, up again and down. So that's a second entry short. Or you could wait for 3 or 4 consecutive bear bars. Here's a micro double top. You could short that, but this is up pretty strongly. Or you could wait for signs that the bears are strong. So 3 or 4 consecutive bear bars closing below their midpoints, you can sell at that point. You're selling near the top of a trading range. You could even wait for a strong bear breakout. So here we got 5, 6, 7 bars down. You could sell at the market or sell at closes. Opposite true. Bulls will look to buy in the bottom half of the range. Okay, and sometimes your stop has to be very far. Like below the bottom of this bull leg, maybe even below down here. But if you trade carefully, if you're careful about what you're doing, you'll be okay. I'm going a little fast here because we're running out of time, and I want to talk about some other things. Now, one thing about scaling in, one reason to scale in is it increases your probability. You can say, well, Al, it increases my risk. Yes, it increases your risk, but it greatly increases your probability. So if you use wide stops and scale in, you can win a really high percentage of time. Like 90% of the time if you're a really good scalper. But one key is you have to be trading small, and that's the one thing I think a lot of beginners do not do. They buy more lower, but they trade their regular size, thinking that, oh, Al says a second entry buy should be good. I'll take the second entry buy. Well, you have to look at where your stop is, and you do not want the dollars at risk buying here, buying more here. You don't want that any greater than on any other trade, so you have to trade very small. But if you win 90% of the time, it doesn't matter if you're making very little money per trade, because if you have a lot of those trades, all those little pieces add up, and at the end of the day, you can have a pretty big bag of gold. So you can buy here, you can buy 2 points down, you can buy a new low, right? You can buy a reversal up, you can buy a second entry buy. You don't take all of those buys, but if you buy here, there are several other ways for you to buy more lower. Some people add 2 or 3 times, right? So here, let's say you buy here and you buy more on a second entry buy, wedge 1, 2, 3. Okay, and your minimum profit. So if you buy here, I'm trying to avoid talking too much about actual risk and initial risk, but so let's say you buy here, you buy more here, and it's at least a scalp below that. You can get out break even here, and with a scalp profit there. You know, your actual risk, you know, well, let me just go here. I'll just let those slides explain themselves. But if you buy here, and then you buy more here, you actually had to risk to one tick below this low. So here's your actual risk, and 1 times the actual risk is there. So theoretically, if you buy here, buy more here, you could hold for 1 times actual risk up there and do pretty well. 2 times actual risk up there. Now, one last subject I want to talk briefly about, and that is when you have a trading range that's very tight. Now, a trading range is just a horizontal channel, and like any kind of a channel, it can be very broad, it can be very tight. So fairly broad here and fairly tight here. Okay, when the market has a broad trading range, you can enter with stops, you can enter with limit orders, market orders. But when the range starts to get pretty tight, I would not enter with stop orders. In general, I'm only interested in limit orders and wide stops and scaling in. Okay, a very tight trading range. It's a limit order market, so I do not enter with stops. I do not buy up here, right? I'm looking to sell up there. I'm not selling down here. I'm only looking to buy down there. So to scalp on a tight trading range, if I'm going to take any trade, I want to make sure that most of the bars are at least as big as a scalp. So if the minimum scalp in the E-mini is 4 ticks, if I'm going to be taking any trades, I want to make sure that most of the bars are 4 ticks tall. Here we have a lot of 3-tick tall bars, 2-tick tall bars, really not even good for limit order trading. I also want to make sure that you know, the legs, the height of the range is, you know, maybe at least 3 times bigger than the smallest scalp. So smallest scalp, 1 point in the E-mini. This range is about 4 points tall. So this is about as small a range as I would consider trading. Okay, most traders should not even bother, right? But if you are going to trade, you trade with limit orders. You sell above bars, sell above bars. Look for 1 point scalps. You buy below bars and look for a 1 point scalp, 2 point scalp. Sometimes you get a bull bar near the bottom and you can buy with the stop. Sometimes you get a bear bar near the top and you can sell with the stop. Okay. Okay. You know, this range is fairly tight, but you trade it like any other trading range. You're looking to buy low, sell high, scalp, and you're looking to sell strength. You're looking to sell strong bull bars near the top or reversals down. Okay. You can sell, sometimes I'll sell at the prior high and 1 point higher. Sometimes I'll just place a limit order to sell 1 point higher. Same with up here. You can sell at the high 1 point higher. You can sell at the high 1 point higher, 2 points higher, and then you know, get out when it, you know, with a 1 point scalp. You can wait to sell a reversal down. A trading range, you get a bull flag near the top, you get a bull breakout, pullback. I often sell, especially if the signal bar is not very good. Here we have a bull bar, but a big tail on top, at the top of what appears to be a trading range. I'm looking to sell that, maybe sell more 1 point higher, looking for at least a 1 point scalp. Opposite's true at the bottom. You know, I'm looking to buy at a new low, buy it at a new low. You know, buy more lower, 1 point lower. Buy reversals up. Buy a strong bear close. Okay, we got a bear flag, a bear breakout, a pullback, so it's the bear flag. So I'll buy at that low, betting that the bear flag will fail and that the market will reverse. All right, so I tried to cover a lot. I'm losing my voice. I talked about limit order bulls and bears. I talked about gaps. I talked about whether or not a swing or a trend is actually a trend or a leg in a trading range. I talked a little bit about second leg traps. You got to be careful about buying too high in a in a trading range, even if the breakout looks very strong. You got to be very, very careful about selling very strong bear breakouts at the bottom of a trading range. Unless it clearly breaks strongly far below the range or far above the range, you have to assume the breakout attempt will fail. And then I talked a little bit about scaling in. That if you use a wide enough stop and you scale in and you trade small enough, you can greatly increase your probability. As I say, a really good scalper who's willing to scale in and enter with limit orders can win 90% of the time. Now, I'm going to open it up to questions. I don't know if I can do that or if the...
I will ask them for you, Al.
Okay.
Let's see. What are the 2 or 3 most important things to look for when trying to establish the bullish or bearish context?
I'm sorry, I didn't hear the last part of the question.
All right, let's see. What are the 2 or 3 most important things to look for when trying to establish bullish or bearish context?
Context?
Yes.
Okay, for me, context means all the bars to the left. And, I'm always looking to see, let's say we're looking at a breakout, and the current bar, the past 2 or 3 bars look very strong, but they are still below the top of the range of the past 20, 30, 50 bars. So first of all, if I'm looking to buy high, I want to make sure that I'm buying really high, well above everything to the left. I don't want to be buying high if it's simply a buy vacuum test of the top of the range. And then, like I said, the first things I'm looking for, let's say the market's going down or going sideways, the first thing I'm always looking for is, are the limit order bulls making money? And are they making money just 1 or 2 times? Or like this morning in the first 2 hours, where there are 10 times, 15 times when the limit order bulls can make money. And if the limit order bulls are making money, I start getting really eager to buy. I'm one of those bulls. I probably bought a bunch of those limit order trades. So first thing I look for if I'm looking for a bull breakout is whether or not limit order bulls are easily making money. And then I look to see, can the bulls now start to make money with stops? So if they're making money with limit orders and now they're starting to make money with stops, and if the context is good, like if, let's say this morning we were in a sell climax and a wedge bottom, I'm going to start looking to buy. And then if I start to see a bull breakout with 2 or 3 consecutive bull bars closing near their highs, chances are the market is becoming a bull swing, and I'm looking to buy closes, or I'll start looking to buy below bars. I hope that answers the question.
Okay. Let's see. How do you manage portfolio risk when legging into trades? Is a potential of hitting risk limits before the set has seen its potential?
Yeah, that's a really important question, and I touched on that in the last 5 minutes or so. And I talk about that a lot more in the new version of the course. The key thing is position size, right? And I could have spent 10 or 15 minutes talking about that today, but I wanted to cover other things as well. But the most important thing is position size. So if you're buying and you're planning on scaling in lower, first thing I look at is, where is my stop? Okay, so let's say my stop is 10 points below. And let's say normally I do not want to risk more than 10 points on a given trade per contract. So if I'm buying and my stop is 10 points below, and I buy more, 2 points down, so now I have 10 points risk on the first one and 8 points risk on the second one. I got to be really, you got to be trading really, really small, a fraction of your normal position size. For me, it's usually, I think in terms of quarters. So if I'm planning on scaling in and using wide stops, I might trade a quarter size for my first entry, another quarter size for my second entry, and just rely on the stop. and then if it goes all the way down near the stop and I get a reversal up, I'll put on maybe another quarter or another half. But the single most important thing is you got to trade really, really small, so that even if the worst thing happens and it goes all the way down and hits your stop, you do not lose any more on that trade than you do on any other trade. And if you do that, it's very easy to stay objective, and it's very easy to manage your trades, and it becomes pretty easy to make money. Okay?
Okay. Okay, so they're asking, so beginners should not trade trading ranges.
No, that's not true at all. It's harder for the beginner to make money in a trading range unless they buy low and sell high, all right? And especially if they are willing to take second entries. So if there's a little micro double bottom at the bottom and both buy signal bars close on their highs, to me that's a good trade for a beginner. And at the top, if the market goes up to the top of the range, even if it races up to the top, that first slide that I showed with the second entry short, that is a reasonable sell. You had a micro double top, both sell signal bars closed on their lows. Taking that second entry short, I think, is a very good trade. The math is very good for that.
Okay. What is the minimum target for second entry short?
To me, it depends on what I'm doing. If I'm going for a swing, and it's a logical swing, and there are clear measured move targets, far below, I'll try to swing at least part for that target. But in general, if I'm trading the E-mini, my minimum target is always 1 point, right? So I'll never take a trade with the intention of exiting with less than a point. If the range is big, let's say 15, 20 points, and the average bar is 10, 15 ticks tall, then I'll increase my minimum target to 2 points. And if the range is really, really big, sometimes I'll go for 4-point scalps. But most days, if I'm trading for 4 points, I think of it as a swing. If the bars are big and the legs are big, 4 points can be a scalp. And I touched on actual risk and initial risk. Again, I don't want to spend a lot of time on it because it's just covering too many topics. But in general, if the market goes against you and then goes your way, and you look at how much you have risk to not get stopped out, that's your actual risk. Any trade that you exit with a profit equal to 2 times your actual risk, mathematically that's a good trade. 100% of the time, that's always a good trade.
Okay. At the open, what signals you that you can sell the tops of bars and buy the bottoms for scalps?
Okay. If you're ever in my trading room, my chat room, you'd hear me talk about that every day. I like to scalp a lot on the open, and I look at context. Let's say yesterday's a trading range, and today's opens in the middle of yesterday's range, and the first bar of the day today is a big bar with a small body. So we've got a trading range environment. The first bar of the day is a trading range bar. I'm going to be buying below that bar and scaling in lower. I'm going to be selling the high of that bar, scaling in higher. On the other hand, let's say we have a big gap down testing the 60-minute moving average, and we got a big reversal up on the first bar, a big bull trend bar closing on its high. I'm going to bet that will continue up, and I'll buy with a stop 1 tick above the high of that bar. So that's more of a stop order context, whereas the first example I gave is more of a limit order market. I talk about this every day, especially in the first hour, because it's just so important. It's so many opportunities to make money, and it also gives you good insight about what the rest of the day will be like.
Okay. Dovetailing from that, can you talk a little more about how you diagnose the day as a trading range versus a trend?
Well, one thing, if you read my blog every day, especially the one that I post around 7 o'clock Pacific time, I talk a lot about that. After that first 30 minutes, sometimes first hour, what I'm doing is I'm commenting about what I think the rest of the day will be like, right? So first of all, if the context is sort of a trend, right? Let's say yesterday's a really strong trend, and there are magnets above, resistance far above. Chances are today has a significant increased chance of being a trend. If you get a big gap up to a resistance level and then a strong reversal down, you got to be thinking about a trend. If you had a lot of trading range price action yesterday, the past 5 days, the past month, you have to assume that today will have a lot more trading range price action. If the day opens up and it looks a lot like this, a lot of reversals and a lot of prominent tails, small bodies, you got to be thinking that it increases the chances for trading range price action. This particular day we rallied, but if the open is like this, I start thinking that the day will probably have a lot of trading range price action. So sometimes the very first bar of the day tells me that the day will have a lot of trading range price action. Sometimes it takes me 5 or 10 bars to figure it out. Sometimes the market will go sideways for an hour or two and then break out. And when that does, I'm assuming the breakout will go far enough for at least a 2 to 3 hour swing.
Okay. Okay, they ask, can you give some stats in your work such as breakouts above bull channels will fail 75% of the time? How did you come up with this number? And is it valid for any time frame or instrument?
It works on all time frames. I came up with it. You're not going to like my answer, but I'm going to give it to you. I came up with it by day trading for 30 years and looking at every tick in the E-mini or the S&P before the E-mini for 30 years. And I've just done this a long, long time. I'm trying to come up with guidelines, just general guidelines. Again, I talk about them all the time. I'm just trying to make it easier for traders to think about what's likely to happen, what's not likely to happen. And if you read my blogs again, I'm not telling you to read them, but if you want to learn more about how I think about these things, I post it every day in my blogs. And I pay a lot of attention to what is likely and what is not likely, and it's just all personal experience. I say that, but I've probably spent over 10,000 hours testing all kinds of ideas and writing all kinds of systems. I haven't done it in 15 years, but I've done a lot of testing, so I have a really good sense of probabilities.
Okay. At this point, I just want to tell you we're getting a lot of comments. People seem to really like the slides. They like the new slides.
I'm sorry, what?
They're liking the new slides and new graphics. They think it looks really, really good, and seems to be enjoying it a lot.
That's good. I'm glad. I wanted to make it much more easy, and I also wanted to make it visually more interesting so that it's just not so boring.
Yeah.
I'm already a boring guy. I got a boring voice, so I got to try to make interesting slides.
All right, let's see. Do you consider areas where stops may have accumulated when evaluating the quality of a reversal bar?
I'm sorry, would you repeat, please?
Do you consider areas where stops have accumulated when evaluating the quality of a reversal bar?
It's really interesting you bring that up. I feel like a wolf. I'm ready to pounce on stuff like that. I'm always paying attention to what should happen and what should not happen. And if something should not happen and it happens, you're probably going to get followed through. For example, just look at this slide. You got a double top, or even here, double top. It should not break out, but not only did it break out, but it broke out by a lot. That means the scale and bears who sold these highs are trapped, right? And the bulls who did not buy are trapped out, and they're looking to buy. So, I always pay attention to high probability trades or high probability events. If a high probability event fails, that means everyone's on the wrong side, or a lot of people are on the wrong side, and I'm really quick to enter because there's so many, bulls and bears are both trapped. One side's trapped in, the other side's trapped out, and I try to get in as quickly as I can. So I do that. I also gave that example of that. The first slide that I showed of the Second leg trap, there's a wedge top and a bull channel and a big bull breakout. In general, if you have a wedge top, a lot of traders will sell the reversal down, and they'll put a stop one tick above the wedge top. Now you say, if it gets above that wedge top, we're going to break out and go strongly to the upside. No. 50% chance if it breaks out above that stop, you're going to get a swing up. 50% chance the breakout will fail and reverse down. And I adjust those percentages all the time depending on context. But so some things you think are really high probability, they're not. They're much lower probability than you think.
Okay, when scaling into ranges, how far is your wide stop relative to your target?
I don't care. All right. It's not like I do a fixed thing. I ignore the price scale on the right, and I just look at the chart, and I just look at where the stop has to be. So let's say I'm buying this low right here, right? My stop has to be here. I don't care if it's 2 points or 20 points. My stop has to be here. So if I buy this close or I buy that low, and I'm planning on scaling in, that's where my stop's going to be. So I look at where the stop has to be. I'm usually looking at support and resistance. A lot of times I'll base it upon the bottom of a bull leg. Let's say I'm selling up here, right? Betting that the bull breakout will fail. I know I have to risk at least a measured move up, because if there's a successful breakout, it could go up for a measured move. So if I'm selling here, the measured move up would be from this low to that high. So I need to stop at least up here if I was going to continue to hold. So I don't care how many points that is. I just know that's where my stop is. In a way, it's a lot easier to think about it in terms of Forex markets. Sometimes you get really tiny ranges, other times big ranges. And I just never, I don't pay attention to this. I pay attention to where the stop has to be based upon the chart, and that determines my position size.
Okay. How can you recognize when a second leg trap is not a trap but a low probability measuring gap?
A low probability what?
Measuring gap.
A measuring gap? You never know in advance, but that's what I'm saying, that if you're not sure, I gave examples of ways to increase your probability. So let's go back to that example that I talked about several times, the first one, the strong bull breakout above the wedge top. At the time that it happened, at the time that breakout happened, the odds were the first pullback would be bought, right? So the odds favored the measuring gap. And it pulled down 1 bar, and then it rallied up 1 bar and reversed down. And then you had that second entry sell. At that point, the probabilities favored the bears. So initially, if you have a strong breakout, the probability favors that the first reversal. Well, here, look at this. Okay, strong bull breakout, big enough breakout bar. The first reversal down probably will be bought, right? But if you get a second reversal down, the math starts to shift in favor of the bears and away from the bulls. Here, it didn't become a bear trend; it went sideways. But low probability sell here, buyers below. But now you have a second entry sell, higher probability that it's going to go down instead of up. Or you wait until you get 3 consecutive bear bars, right? Or 4 or 5 consecutive bear bars. Or you wait for a big reversal down. Waiting for those things increases the probability that the breakout will fail. So there are things you can do. You can wait for things that increase your probability. I know you can say, well, Al, I don't want to sell after 4 bear bars. I'm selling too low. There's always a trade-off. If you want better probability, right, you have to give worse risk-reward. So that means you have to take more risk or less reward or some combination of the both. Theoretically, there's always an institution taking the opposite side of everything you do. So if you're taking a low probability trade, chances are you have really good risk-reward, and the institution has the opposite. If you're waiting for a high probability trade, chances are the institution, there has to be some reason for the institution to take the other side. He's taking it because if you get high probability, he has low probability. If he has low probability, he has to have a great risk-reward situation. So you're always trading off probability versus risk reward. One of the things that drives me nuts when I watch TV is I hear some clown, some expert on television talking about, oh, this trade is a really good risk reward. That's stupid. Don't tell me that. Tell me what the probability is in addition to the risk reward, because risk reward alone is not a reason to take a trade. Most of the guys, when they talk about risk reward on TV, they're implicit in that is the probability is about 50-50. They don't say that, but that's true. A lot of times if you watch options action, a lot of times you'll hear them say, oh, this risk reward is really good, all right? And what does that automatically tell you? Okay, that you're going to lose money, all right? Anytime you have a trade where the risk reward is really good, the probability is going to be bad. So a lot of times on options action, they'll talk about, oh, this trade is a really good risk reward setup, but they rarely ever tell you that you're probably going to lose money, all right? Anytime you take a trade where the reward is far greater than the risk, the odds are it's a loser. So you can make money doing it. Let's say you take the trade 100 times and you win 20% of the time. You can make money doing that if the reward is 6, 7, 8 times bigger than the risk. But do you really want to lose 80% of the time? Not me. I want to be happy. And I'm not happy if I lose 80% of the time. I don't care if I make money. I want to be happy. If I'm a machine, it doesn't matter losing 80% of the time as long as you make money.
Yeah.
But I'm a guy, and I want to be happy. So I need trades where I'm going to be winning a lot, and that means I have to take less risk reward.
Okay. I'm gonna group a couple questions together, but there's people asking about NYE or NYSE tick, volume profile, pivot points. Is there any other things like that you use in your trading?
I've used everything. I've been doing this for 30 years. I've used everything at one point or another, and I'm interested in having fun and making a lot of money. And there are many ways to achieve those two goals. And for me, I take 20, 30 trades a day, sometimes 40 trades a day, and I have fun doing it, and I make money doing it. If I add other things, pivot points, I think are a joke. There's a whole bunch of things out there that I think are really not. Ticks. Every now and then I'll pop up a ticks chart in the room to illustrate a point, or a volume chart. Sometimes I'll pop that up to illustrate a point. But I see so many things on a 5-minute chart. I see trades pretty much on every bar of every chart. So if I start adding indicators, stochastics, or bands, or pivot points, or DOM trading, or anything else, I don't need any more trades. The day has 81 bars on it, a 5-minute chart of the E-mini. I see 80 trades, probably 40 reasonably good trades. And adding any of that other stuff, do I need to see 82 trades? Do I need to see 83 trades? No, I already see a whole bunch. So for me, if you get really good at reading charts, you see so much stuff that, who cares about adding anything else? You already see far more trades than you possibly could hope to take. So for me, I'd much rather get really good at just reading what the charts are telling me, and I just see so much. It's incredible. I just see so much that I don't want to see anything else. So all I need is my charts.
Yeah. Okay. When scaling in, will you use the original stop, or does your stop adjust?
If I'm scaling into a trade, usually I'm using a very wide stop, and that means I'm theoretically trading small. A lot of times I'll have a lot of confidence in the trade, and I will not trade small. I'll trade a regular size, so I'll end up risking theoretically more than what I normally would like to risk. But anytime I take any trade, the first thing I think of is, does this trade make sense mathematically? What's the probability that I'm going to achieve my goal? Where do I really need my stop to be? Where do I have to put that stop, right? And that stop is really important to me, and I don't mess around with it. If I see where the stop has to go and it has to be far, If I'm going to take that trade, that's my stop. I don't care that the stop is far. If that's the best way to structure that trade is to use a wide stop, I got to use that stop. And sometimes that means I have to trade small. That's okay.
Okay. Can second leg traps eventually fail into a strong breakout in the original direction?
Absolutely. That's really, that's really common. I kind of view the market as kind of like melted plastic, and everything, it can be bent into any kind of a shape, and every now and then I'll see some clown on TV. There's one clown in particular, I'm not going to mention his name, who's very lovable and very nice, but he uses words like never or never in my lifetime or always, and those words are always wrong. I already talked about probability. I said 10% of the bars on the chart are high probability bars, right? But there's not 100%, there's 60 or 70%. 90% of the bars on the chart, the probability for anything, the market going up or going down, it's in a band between 40 and 60%. So if you have a second leg trap and it starts to reverse, it can resume back up very, very easily, right? And become an actual breakout. In fact, most breakouts that you see begin with the look of a second leg trap, right? And you're debating, is the breakout big enough? Is the context good enough? What's more likely, a reversal or a resumption up? Is it more likely that this is a top or is this a bull flag? So it's pretty common. So you have to evaluate the context. I gave one example at the end of the second leg traps of a very strong bull breakout. And if the context is very strong, the odds are very high it's going to keep going up. If the context is terrible for a breakout, chances are you're going to get a trap.
Okay. Do you take any kind of fundamental news into account when you trade?
Very good question. I have a really strong feeling about that, and the short answer, absolutely, positively, no. There was a show that was on the air a few years ago. I forget its name. I think it was Money in Motion or something. It was about Forex trading on CNBC, and it went off the air after about a year or two. And in my mind, the reason it went off the air is because of that very question that you just asked. These idiots on TV were saying, "Oh, the krona is going up because of who knows, crude oil, or the euro is going down because Greek might exit." That's total garbage. It's totally garbage. And they say, "I'm taking this buy of or I'm selling the euro versus the dollar because we're at resistance and because the Greek might leave the European Union." That is such garbage, right? If you're selling at resistance, you're selling at resistance. It has nothing to do with these stupid fundamental explanations that people tack on. They tack them on to sound smart. And I see that on options action as well. They'll say, "Oh, the market's going up and there's a good catalyst coming out. The iPhone is going to be really good, or the iPhone is going to be really bad." That's total garbage. I'm working on an options course as part of my trading course. I'll talk a lot more about it. I'm running out of energy on it right now, so I'm going to put that off 3 to 6 months. But when I see those guys on options action start talking about, "Oh, we're breaking out to the upside and there's they have a good product," that's crazy. You don't buy because it's breaking out to the upside and the company is coming out with a new product. You buy because it's breaking out to the upside. Everyone already knows it's coming out with a new product. That's why it's breaking out to the upside, right? So to me, the institutions and the smart guys, the inside guys, they know all that stuff long before it becomes news. And the market, when you're seeing the breakout or the reversal, it's because the institutions already know all that stuff. And if you just start to say, "Oh, I'm doing it because I'm smart. I know Amazon Web Services or cloud services are really good, That's garbage. Knowing that stuff is garbage. The smart people already know all that. It's already baked in. So anytime I hear anybody say, oh, we're at support and we're going up because of the company's earnings are going to go up, I think that's garbage. I just cringe. I can't tell you. I can't. It's religion. These people believe in some kind of idiotic religion. And it's totally nuts. Whenever I hear a person say something rational, we're bouncing at support, I'm going to buy. And then they add the stupid thing on at the end, and the company has a great new product coming out. No, you're buying because it's bouncing at support. The market already knows about the product, so you're not being smart by saying that. To me, you're sounding stupid by saying that. So, short answer to your question, do I pay attention to fundamentals? No.
All right. I just want to take a moment to see how you're feeling. We still have quite a few, about 30 questions or so.
I can't make it. I'm losing my voice. Plus, I got to take a nap.
Is there a email or anywhere where they can contact you to ask the questions directly?
Not at this point. I have two websites, and so people post questions, and on some of the sites now, because of I have cancer, right? I'm using that as an excuse. I can't do as much as I want to do, so I have people who answer some of the questions for me. I try to answer a lot, but I just get especially right now, I'm dealing with my new life situation.
Yes.
I just don't have the energy to do too much. But they can look at the Brooks Price Action site and the Brooks Trading Course site, and there are places in there where people can post questions.
Okay. There's quite a lot of comments. Everyone wishing you complete recovery, quick recovery, and thanking you for taking the time to do this webinar after your surgery.
Yeah, I appreciate that. I really want to be helpful to people, and right up. If there is an end to this, I want to be a good person right up to the end. So it makes me happy, and I'm glad that people. I'm happy for the nice wishes. Everyone's been really, really nice to me.
Okay, that's good to hear. I think with that, we will close the webinar. It's been a complete honor to talk with you today. I'm one of your students. I've read all the books, watched the course, so this has been really exciting.
I'm glad. I'm hoping I was not talking too fast. And I appreciate everyone being patient with me, and also I appreciate everyone listening. And I wish everyone the best of luck. Thank you.
All right, you too. Thank you, Al.